Welcome back to another episode of Tax Talk Unfiltered. Possible new name in the works, but we're still Tax Talk Unfiltered for this episode. I'm Spencer Carroll, joined again by Rachel Richards and Tal Binder, and this is an episode that we are talking about something maybe a little bit unexpected. Unfortunately for the three of us here, it's something that we deal with almost on a yearly basis. All three of us are Floridians, and we are talking about natural disasters and how they impact your taxes. It does have an impact, rarely utilized and understood, but when you go through a natural disaster, it's important that you work with a team that understands and helps you get the most out of it, especially if you've unfortunately experienced a loss. So we're going to talk about the history, what is a natural disaster, what can be claimed, and the impact on your taxes. We'll start by kicking it over to Tal. Tal, would you give us a brief history on natural disasters in the United States?
Yeah, but before I get started, I want to tell you thank you. I think it's the first time that anybody addressed me as a Floridian. So now I feel like a Florida man.
Yeah, you are a Florida man.
Besides that, Rachel sent me, I think, a small book about the history of Florida when I moved here, actually. That was very nice.
It's like the Florida man.
Yeah, and my friend sent me like a tank top of Florida, with a big famed Florida man when it started, and I didn't even know what it means. But yeah, thank you. Basically, horrible things happen every year in the US. It can be anything from the fires like we have in California to hurricanes to floods. It can be so many things, but bad things happen in the US. And of course, the damages that those kind of natural disasters create, that usually it's not a man-made disaster. Basically, it's something that nature creates and we don't have a lot of control over. The damages that it creates, it can be very minor, but it can be huge in the hundreds of billions of dollars of damages. When something like that happens, there is a question, what can you do? So a lot of people are basically insured. They're insuring themselves, but as you may know, insurance is limited. Insurance doesn't cover everything, and insurance can also drop you. So you might have insurance, you might not have insurance. If you do have insurance, what exactly does it cover? What kind of damages does it cover? What are the limitations? There are a lot of questions around that. But when we're looking at it from like a tax perspective, the time is really split into two. There is the pre-2018 tax situation about natural disasters, and there is the post-2019 natural disaster and what you can do about that. Pre-2018, you could basically claim any personal damages, any casualty, any damages that you had on your, I think it was on the itemized deduction, you would be able to claim it. But you didn't have any limitations on that.
Well, no, it had to exceed 10% of your income before it started becoming deductible. So you could claim anything.
You still have that.
But not for casualty due to a disaster.
But that's only since 2018.
Okay, fine. But you always had the 10%, you had the 10% limit, and now you don't get to take the casualty loss for as much, but in the case of a disaster, it's much more favorable.
Yep.
Fair.
So completely fair, and that's completely fine. It's basically a big change. The 10% is, if you think about that, it can be huge. If you make $100,000 and the damage was $10,000, that's a big damage because you need to somehow pay for that. And let's assume that you don't have insurance, or the insurance doesn't cover it. $10,000 to pay it out of pocket and not being able to claim it as a deduction from your taxes or anything else, that's a big thing. Let's take 2022, for example. There were 18 events in 2022 that resulted in about $165 billion in damages. Actually, Hurricane Ian created $112 billion of those damages. And it's something that is recurring, that one big event is responsible for the majority of the damage. But specifically in the US for natural disasters in 2022, about only half of the damages are being insured. So only about half of the money is being basically paid back to people by insurance.
Which means the other half, people need to be thinking about claiming it on their taxes. Is that what you're saying?
They should think about it, what they can do with it. There is a question, can you claim it on the taxes? You cannot claim it on the taxes. what are the limitations, that we will talk about those in a second. But if you think about it, that's a huge amount of money. So if we had like $165 billion in damages and only about 82, $83 billion were covered by insurance, you have like basically over $80 billion of damages nobody is accounted for. Saying all of that, when it comes to tax deductions, only 0.24% of all taxpayers are actually claiming casualty or theft loss deduction on their itemized deduction. So even though like you have those disasters every year, and like almost every year, and every year it claims like at least tens of billions of dollars in damages, a tiny fraction of taxpayers actually claim any deductions on those cases, which I think it's crazy.
Why do you think that is?
Why they don't do that?
Yeah.
I think that number one, education. I think that they don't realize what they can do, how they can do it. Also, there is like a little bit of complexity around it, like what kind of like information you need to collect. How do you prove that the damages are the damages? If you have insurance, they usually send somebody to you and tell you, okay, you say that you have $20,000 in damages, but because it's insurance, they send basically an appraiser for you and say, okay, you do have $20,000. Oh, no, really, you have $8,000. We're willing to pay up to that amount. So when you don't have this kind of like framework that somebody else that is their job doing for you, it's hard for people, I think, to understand, number one, how to estimate it, and number two, what exactly do I need to do when it comes to the taxes if the insurance didn't cover everything or it didn't cover anything at all.
Okay. So you're saying, Tal, that prior to 2018, you could claim pretty much losses from anything back in the day, and then now it needs
with
to be
limitations, but yes, as Rachel said.
Now it needs to be specified for either of you. What does that mean? What counts as a disaster that creates losses that you can take on your tax return nowadays?
So today, a disaster loss is going to be limited to a federally declared disaster. So that's pretty much going to mean if FEMA declares it as a federal disaster, then you're essentially guaranteed some sort of IRS relief. You'll be able to take a casualty loss if that applied to you. There are benefits from taking distributions and taking income from retirement plans. Most likely, your payments will become suspended if you have an installment agreement. You won't need to make those installment agreement payments. If you are supposed to pay estimated taxes, there won't be any penalty or interest for not making those estimated payments. And your due date for filing your tax return could even be extended. So depending on the severity of the disaster, any number of benefits could open up to you. But the key is really FEMA declares it a federally declared disaster.
Okay. So FEMA needs to declare it.
And it'll be your county that it gets declared in.
Oh, okay.
So it's not necessarily just your state, but it's based on where you live at a certain point in time.
Okay. Interesting. So FEMA needs to declare it. Mentioned at the top, all three of us are in Florida, different parts of Florida. And Tal, you got hit more than us, unfortunately, in 2024. What are some examples? California wildfires, we had some hurricanes. What are some examples in 2024 of disasters that did get that FEMA declaration?
So you mentioned some of them, but honestly, like apparently in general, the IRS is publishing a disaster relief quite often. It's quite.
There's so many.
We tried, by the way, internally to build a list so you can choose what disaster happened to you and you filed the taxes with us. It's just like so many disasters and so many federally declared disasters that it became like not unreasonable to expect. But yeah, I'm living in South Tampa by the water. And when last year, 2024, we had two major hurricanes that hit our neighborhood, which is Hurricane Helene, I think, and Hurricane Milton. So luckily everything is fine and nothing like body-wise happened and everybody's healthy. But there was some, because we're living quite close to the ocean, we had some damages to the property. We are insured, by the way. So basically any disaster that the federal government is, FEMA in this case, like is declaring that as a formal qualified disaster, that's something that can be tax beneficial for you, whether you have an insurance or you don't have an insurance.
And even federally declared disaster, usually people think, oh, but my house wasn't devastated. I didn't have a lot of damage. If you lost electricity and you had to throw out everything in your fridge and freezer and you had some nice steaks in there, that's expensive. So any type of loss that you had where you had something that had value and then after this event you don't have that thing anymore or the value of it has gone down, that's considered a loss. So think about things that, what was in your fridge. If you lost power, definitely. Even your landscaping. Trees are really expensive. You don't necessarily have to replace, if you had a big oak tree that fell down, you don't necessarily have to replace it in order to recognize the loss, because you still had something that was valuable and now you don't. So just thinking outside the box of just because you weren't totally devastated by something or you got really lucky doesn't mean that you don't have an opportunity for a tax benefit.
Would you guys say that the general rule of thumb is if it's something that's insured, go get insurance to cover it versus your example, Rachel, of like landscaping, trees, stuff you have in your house that maybe isn't insured, claim it on your taxes, or is it not that clear cut?
I don't think it's a clear cut, and I'll explain why.
It depends, yeah.
Like everything, like it depends what the size of damage that you had and what are the consequences of in your cash flow, how much it is for you, and your insurance situation. For example, we had insurance, but depending what the insurance covered, that it was not worth it for us like to activate the insurance. We prefer just like to take the tax deduction. When you activate an insurance, it can go into when you sell the house. Sometimes in certain counties or states, you need to basically disclose that you activated the insurance for whatever it is. That's option number one. Number two, like they're going to increase your rates. The moment that you start to claim your insurance damages, depending how much it is, the next time that you're going to renew the insurance, they say, oh, you basically filed a claim. It's one of the questions that like everybody is asking you. Now, I don't know, I'm not an insurance guy, I don't know how much it affects, but I'm sure that it doesn't affect it positively. Let's put it that way. No matter what happens behind the scenes there. So it sure depends on how much damages happen to you. There is also the question, let's say that you think that you have $20,000 of damages. And let's say that you even have a proposal to fix it for $20,000. The insurance might send somebody to your house and to create an appraisal, and they will say, no, it's not $20,000, it's $5,000 of damages. That's another thing that you want to take into account. What you believe the damages are does not necessarily mean that those are the actual value or those are the damages.
And so if you have these losses, you want to claim them on your tax return, you have to be able to itemize your deductions. Is that right?
No. With the disaster losses, they are generally an itemized deduction, but if you're taking the standard deduction, you can take a casualty loss due to a federally declared disaster. And if, say, the disaster happened in May and you had filed your tax return in April, you don't need to wait until the following year. You can amend your prior tax return, or if you haven't filed your tax return, claim it on the previous year's tax return so you can get the benefit of taking that loss sooner.
Okay. That's awesome. Yeah, because I was thinking you had to itemize, and if you're someone that doesn't have a lot of other itemized deductions, you'd almost need to have a loss close to 15,000 or more or 30,000 or more to make it worth it, but you don't have to have that.
I think I told you that, but we lost three big trees. We have palm trees.
Trees are expensive.
I didn't know that, but yeah, apparently those are very expensive. Number one, to clean up. It was very expensive to clean the trees up because you needed to they were big trees, so you cannot just bring a bunch of people and lift them. They need to bring heavy machinery in order to get them out. Now there is a question how to replace them. Apparently it takes a long time for trees to be planted, all the roots, stuff that I didn't even know about. Apparently it's really expensive.
Yeah.
And I doubt that most insurance will cover your trees, for example. And that's another thing like to be mindful of. Let's say you have flood insurance, and let's say that the insurance will cover all the flood damages. everything is fine, but it will not cover, for example, it didn't have a hurricane coverage. Something happened to your roof because of the wind, it doesn't cover that. You can still activate the insurance and get the money for whatever they are willing to pay you, and then any difference and any additional damages that are not covered by insurance, you can take it against your taxes as well and claim that as deduction. Even if you don't fix it the same year, you might not have the cash or the money, or you don't want to fix it the same year, but it is really important to bring, when it happens, if something like that happens, to get some professionals on your behalf to give you quotes about how much it would cost to replace it. So you want to start, the first thing that you want to do when something like that happens is documentation. Document what happened, take pictures, take whatever you needed, just make the documentation. The next thing, you probably want to bring somebody in, professional, depending on the damages. If it's a roof damage, you want to bring roofing company to tell you how much it would cost to fix the damages. Or alternatively, if you need to replace the roof, you need to get a quote for the roof. You need to start creating documentation and basically a case for what happened to you, what are the damages. If you have pictures before the damage and after, that's even better. But you need to start building the case around it in order to start the claim. You cannot just say, I had $20,000 of damages without a base for that. You need to have like professionals either appraise that or give you a quote to tell you how much it would cost to replace it. A quote to replace, by the way, for in my case, I'm going to claim for sure the cost that it cost me to clean up all the trees, to pull the tree, like to pull out the trees, clean it up. That's part of the damages. I needed to clean the whole thing up, and then replacing it, how much each tree cost, how much they worth. Try to appraise it, try to estimate it, get professionals, ideally specialists in the field. There is not a clear cut of what you need to do and what kind of documentation you must have. But the more documentation, the more you show that those are the damages, this is how I came to the conclusion that those are the numbers, and it's not based on my feelings, it's based on those facts and those professionals, the better the chances that you can claim more money even for on the tax return.
I was just going to say that the disaster might take your house, but they can't take your documentation.
Depends how you save the documentation. There is actually your sentence, Rachel. What's bad for life is good for taxes.
Good for taxes.
That's a perfect example of that happens. There is another thing. We can take it one step further. Let's say that you're making $300,000, $400,000 a year. You had damages, you didn't activate insurance, or you activated insurance, but beyond the insurance, you have $120,000 of damages, all included. So suddenly from, let's say, $300,000, you're going to pay taxes on $180,000. It's much less taxes. And of course, we like to look at the fuller part of the glass. And what you can do in those cases, backdoor lot conversions. I know the last thing that you want to really think about is your retirement when it happens. But if you have a tax year where your taxable income is lower than what you usually have, those are great opportunities to take advantage of loss retirement accounts. Contribute more to accounts that like the Roth, or do any backdoor lot conversion. If you already have in a pickle, at least maximize the benefits, whether it's taxes, insurance, or retirement. So I think that's something that is really important for people to keep in mind, that you always have opportunity, especially in disaster, and don't let a good disaster, or a bad disaster, depending what happened, don't let a disaster to slip away. I'm not sure if that's the phrase, but yeah.
Let a good disaster go to waste.
Yeah, exactly. Thank you.
All right, Rachel, anything else you want to add?
The only thing I would add is if you are in a situation where you're displaced from your home or your business, if you work from home or if your business needs to relocate temporarily, if the relocation is expected to last less than a year, then all of those costs can be considered travel expenses for business purposes. So something to keep in mind, that's something specific to travel related to a disaster relief. If unfortunately you needed to relocate, or your home was unlivable, or your place of business, then there could be a tax opportunity there.
Yeah, there you go. Moral of the story: bad for life could be good for taxes. Don't let it.
Almost always good for taxes.
Always good for taxes. Don't let a good.
But it goes the other way too. So good for life.
But obviously we're sympathetic to people that go through the natural disasters, and and struggle through it. But that's what people like us, teams like us, are here to do, is to at least help you put things back together from a tax and financial perspective. All right. Thank you, Tal and Rachel, as always, for sharing your knowledge with us. Thank you for listening. And we want to hear from you. We want to make this worthwhile and valuable to you all. So if there's a topic that is just a burning question in the back of your mind, let us know. We'd be happy to make an episode about it. So thanks for listening to another Tax Talk Unfiltered.